to another episode of Life with Kyle. Our investing segment continues. The saga continues. And wow, what a 3 days it's been. It's been crazy. Just like we predicted, the Fed came out and basically said, hey, our printer's out of ink. Rev up the rest of what you can do so we can replace that cartridge, get stuff rolling. So obviously, if you're here, guys, you want to learn how to invest in these crazy markets right now in 2020, whether it be an opportunity to capitalize on potentially cheap stock and let it grow out over time, or you're just wanting to try to play these volatile markets here and there, day trade it, whatever it may be. Whatever it may be, I'm going to try to give you my analysis on how I look at the market in times of volatility like this. While everything is as crazy as it is, there is ways to trade it. So I'm going to go ahead and give an analysis of that right now, let you guys see how I do it, but this isn't saying, hey, buy this stock, buy this stock. That's not what this channel is about. I am just going to tell you some of the stuff I see, some of the stocks I actually watch, and we'll give my analysis, my thoughts, my ideas, my opinions on that, and take from it what you will and interpret your decisions that way. So without further ado, we're going to look a little bit over what the Fed said, some of the things that kind of just reiterated what everybody already knew. Not too much shocker there. Additional stimulus that's possibly coming out. More surgeons cases in Wuhan. I want to just briefly look at that and mention that because that's a big factor that nobody's really paying attention to, and that's where this virus originally started. I want to talk about some predictions I think that might occur in the coming weeks, something that might have a drastic impact on the bank stocks that I mentioned. Once the banks start to go, we could see it trickle down into the rest of the market. And yeah, so without further ado, we're going to be more or less talking about how to navigate some of these markets, some things that as a real investor, you want to be mindful of, that you want to look at. You don't want to just throw money into the market hoping to make a quick buck because it's going one direction or another. You need to be cautious of things that are going on globally. This is a global pandemic. This is where global economics really come into play here. So if you want to throw money at something and try to get a return, go to Vegas, guys. Go throw money on blackjack, gamble there. Don't gamble in the stock market. You're just going to end up losing. It's proven. It's a very, very high odds that you will lose your money. So hopefully I can provide you with a little bit more insight to become a better investor so you're not necessarily just gambling your money away. You can make educated investments on what I'm going to share. So without further ado, let's jump right into some stuff. All right, guys, so as always, we will start by taking a look at the futures index right now, again, on our Bloomberg site. Right now, the Dow is indicating a gain of 67 points at open, or 0.29%. This is as of 6:50 p.m. Right now, I'm not sure how this will look. It looks like we got some selling going on. But all in all, this may hold steady. We've had massive sell-off days, and usually when there's that much selling, the market tends to rally back up thereafter. But we're going to go ahead and take a look at some more important factors that I believe will really begin to impact the markets here shortly. So let's get into that right now. But I wanted to take a look at the futures index. That's a great sign to just start off the video knowing what the market's already looking like so we can base our information off of that. So let's get into the interesting topic right now. Our boy Jerome Powell in his Federal Reserve coronavirus. This is the transcript from when he was hosting his conference today. I just want to point out a few things. From the gist of this, he was basically saying, hey, we're not taking rates to zero, was reiterating that fact. The market was trying to force them to lower interest rates to near zero or even negative. But in an economy like that, how is a company that's failing going to be able to take a loan and actually get paid for that loan when they're possibly going to even go bankrupt? So that was kind of silly for people to even think that was going to happen. And I knew from the start that if this man did that, he was dumber than I could have ever imagined. But right now, he's actually pretty smart for that, so props to him for doing that. But I do want to point out something. He mentioned this twice. So if we scroll down right here, in terms of, if I can say, legislative priorities, we're not responsible for fiscal policy. Those will be decisions for Congress to make. I would say that policies that protect workers, businesses, and households from avoidable insolvency, that keep businesses going so that they're able to produce goods in it and to either hold onto their employees or quickly rehire them, those are going to be key policies. Basically, what he was telling the government to do here is, hey, invest back into the people. Pass bills. Do not worry about the debt you're going to encounter. He's basically going to screw over the next generation to somehow manage that because they want to go out on top, but nonetheless, he's basically telling the government, do whatever is necessary. Do not worry about your debt. Do whatever is necessary to make sure that these people can return to work. Because now he's coming out and saying he's not sure how long it's going to take for us to get back to where we were. There's going to be a lasting scar, in his words, for how long this may last or how long it will take our economy to come back if it goes back to where it was. There's going to be massive changes across the board. He then goes on again to say, in terms of what we can do, I mentioned our credit facilities, are wide open. We can do more on that front In addition, we've had extensive discussions, as I've mentioned, done a lot of thinking about what monetary policy might look like over incoming months, over a range of potential scenarios for the economy. So we heard this earlier where they mentioned that they were going to be buying back bonds for companies or giving out lending programs. He goes on to say that the Fed is a lending asset, basically buying back bonds, buying out corporate debt to help the companies get through their insolvent time so they can stay in operations and continue going. The too big to fail scenario is basically what he was going on to say. But as he says down one sentence lower in the next transcript, with asset purchases, we're continuing to purchase Treasury securities and agency mortgage-backed securities, MBS. That's a key thing there. There's a reason he used it like that. It's a mortgage-backed security in the amounts needed to support smooth market functioning. We're doing those things, and I would say that we will continue to use our tools as needs be. This is why I have a hard time believing that the market will fall to the extent it will. I've been remotely bearish. If you've followed me on this channel much, you've seen that I've said there's no way this is sustainable, and it's not. If we have an event like this, if we have a resurgence in cases, this will be the collapse of our entire government system. We will not be able to come back out of this. But right now, it looks like they're unloading everything they have in their arsenal, and they will continue to do so until things get back to where they were. So picture it like this. Your stock market is operating at 110%. Your economy was at 110%. Then all of a sudden, your economy drops down to 60%. And so in reality, you figure your stock market, which is supposed to reflect your economy, would go back down to 60% and then climb back up with the economy. Well, that's not what Chairman Powell is letting happen. What he's saying is happening is the economy is at 60%, but he's going to remain and keep the stock market operating at 95 to 100% so that the economy will catch back up to it. And once it does, he'll stop putting in as much asset purchasing as needed or buying back these bonds so that the economy and the stock market can then level off again. So what does that mean? It means certain stocks that have already fallen and are flatlining will not drop anymore or should not drop anymore, given that the Fed will continue to fund projects as needed. And so in that essence, it's hard to fight a limitless balance sheet. Okay, you can't beat someone who has unlimited funds. So then the next question becomes, well, where do you invest your money? How do you invest in markets like this if in reality it's supposed to collapse, yet they're basically not letting it? They've got too much money in this market to let it collapse. So they're going to take on tremendous debt to pass that on. Well, he goes on to say, the third thing I would like to point out is just the global dimension. This is a very global phenomenon, and we're seeing economic data from around the globe. That is very important. He's telling investors what to watch for when it comes to market fluctuations, which is very negative. And that too can weigh on U.S. economic performance over time. So I'm going to look at some stuff and show you why you have to do research before you invest in anything in the market. Okay, I'm going to look at some global economic data that when it came out lowered their market and thus had an impact on our decrease in the market. That's kind of what's caused these past 3 red days that we've had within the market of the stocks just dropping tremendously because global economic data has come out that has been far worse than predicted. And because of that, it's basically indicating that, hey, future GDP, future growth is not going to go on like we thought. So we have to adjust. Therefore, we will lower stocks and people will sell off. So it's not saying, hey, we're going to crash, but that is why the market dropped like it did. So let's get into something like that real quick. So right here, China's economic recovery might be slower than expected. Okay, this was published May 12th, 2020. If you remember, on May 12th, the market did go down. So how did this impact, if this is China's economy, how did this impact the United States economy? Well, if you look right here, the National Bureau of Statistics is reporting 3.3% growth year on year for April in its consumer price index, which is a 1% drop from March's consumer price index growth. Meanwhile, the Producers Price Index, PPI, fell to negative 3.1% from a negative 1.5% in April, indicating weaker demand, which has led to producers asking a lower gate price than normal. The main component that drove the CPI in April was food, as its overall price went down by 3%, according to a statement from the Bureau's senior analyst, Dong Luing. Within the apparel category, consumer prices for clothes and shoes decreased by 0.3% and 1.1% respectively. So let's look at something here. As this global pandemic really begins to shed light on countries' economic standing, we see that overall, if we're looking at a global economy, everything has to correlate to each other. If you look at everyone's currencies, everyone's indicators of their economy, they're all going down. Everybody is lowering everything sequentially together. So one of the things I like to do when I'm trading is watch the Asia Open, watch Europe, watch Australia Open, and see what happens to them. If they go down, I've seen almost 100% we go down as well. And the reason being is indicators like this. When news like this comes out, it has to adjust, because there's no way a company can be expecting to do as well as they were last quarter when there's data like this pointing out. There's just no way, because it basically shows that the consumer's not going to be spending as much money, or they're not going to be buying as much. So you have to adjust therefore. Now, that doesn't mean the stock will continue to go down. It will just have a reason to keep day traders confused and be like, oh, the market might crash now. When in reality, that's not what's happening. So they do stuff like this to keep, investors or day traders, because they don't like them, they consider them parasites within the market, guessing and thinking that stuff might fall. So they switch hands and then they just pump the market back up. So you got to be mindful of stuff like that. Global economics and a global pandemic is key to investing through markets like this. So let's go take a look at something else. Now, this might be something that you won't really see on the news. I happened to glance at it over a Bloomberg article and thought it would be something that might be interesting to share. So we have here, Wuhan to use massive testing against COVID-19 resurgence. Russia cases soar. So it seems after weeks, months of isolation and finally beginning to reopen their economy, Wuhan is beginning to see a resurgence in COVID-19 cases. That's indicating that people who've had the virus are not having immunity like they think. So what does this mean for us? Well, if history shows itself to be pointed, as we saw in the beginning of this, Wuhan was reporting cases like crazy. I remember reading articles like this and thinking, when this hits the United States, nobody's going to be paying attention to it because we're too busy focusing on the Democratic primaries, which we were. And so thus you just get ready for the market to crash. But this is something different. If we can learn from this, if our government sees this and actually has a plan of action to combat when this comes back up, we should be better. And it looks like we are. We're doing a lot more testing, as Trump has said, than any other nation in the world. So of course, we have to continue the testing. Now Wuhan is actually testing all of their residents to see if there's a virus increase, to see who's got the infection, who's has it, who's showing symptoms, and so forth. But in this case, we're ahead of the game. We are learning from this. People like to criticize the president for not doing anything, not waiting until the last minute. Well, he's not. He knew from the beginning testing had to be key in this, and this is a clear indicator of why, because a resurgence in cases is possible. So this is something to monitor. If this is happening in Wuhan, then it's a great potential that it will happen back in the United States just because of how fast we are reopening everything. So be cautious when going outside. Be mindful of this, because if a resurgence hits, like we discussed in our last video, our economist thinks there can be a depression. And if there is a depression, you can't combat that in the market. So you can fight it once, but if it comes back again and the market reacts, you cannot stop it. The Fed will not be able to stop it the second time. So if something like this happens, our markets will tank. And then, yes, I don't think we will be able to come out of it. But right now, I think they've saved us, or they've cushioned the blow to an extent. But if something like this happens, you can't fight that. That's going to be inevitable. So watch for that. That's just an indicator to make you aware, because last time this happened, people weren't listening. So watch this. This is why you're watching my channel. You're wanting to know how to invest these markets. These are headlines you need to be watching out for. They won't be talked about much, but until they hit the United States, it's going to be an issue you need to monitor. So that's an example there. I want to talk about more of what the Fed is doing when it comes to buying back those mortgage-backed securities. All right, so right here, Fed makes initial purchases in its first corporate debt buying program. Oh boy, here we go, guys. I thought they were going to do this back in March, but I guess they pulled that bluff on us. Basically, what they said in March was that they were going to begin fighting everything. The Fed was going to be going. And the investing rule of thumb is don't fight the Fed. When the Fed says they're going to do something, that's an indicator that the market's going to flip. So you cannot be bearish. If the market's been going down, you expect it to continue dropping after you've heard that the Fed is going to be doing something. So right now, that's a clear indicator. That's why markets have rallied as much as they have, is because the Fed's indicated they're going to be doing something, but now they're actually doing it. Back in March, when they said they were going to start purchasing stuff, or April, when they said they were going to be purchasing things, they basically just saw that the average investor was like, well, heck, if the Fed's going to do it, I might as well do it too. I might as well get a piece of that cake. So people began buying back in, and the market started rallying up. So the Fed was just sat back and was like, well, hey, if people are going to buy back in, we don't need to do anything. Well, that's not the case. Now the market's kind of stalling, and it could trickle back down. So they actually have to act now. So scroll down, you'll see Federal Reserve Bank of New York said it would start buying exchange-traded funds, which traded like stocks but have broad exposure to corporate bonds. So the term they're using for stuff like this is a, quote, fallen angel. What that means is that companies that, for layman's terms, companies are given credit scores. If you've seen the movie The Big Short, you heard where the guy was mentioning AAA, AA, B, B minus, C minus, D, whatever that may be. Picture that like a credit score. If you have AAA, you've got 800 credit. If you've got an A, you've got 780. If you've got a B, you're about 680, 685, and so forth, etc. So you continue looking at this, and what the Federal Reserve has said they're going to do is buy bonds from companies, incorporate some debt that is a credit rating of like 600 to 500. Which no bank in the world is going to give a great loan to anybody who's got a credit score between 5 to 600. It's very hard to get loans with a credit score of that because it's not the greatest. So the Fed is basically going to just go out and buy debt from companies that have, or issue loans in a lending program. Excuse me, as Jay Powell said, they're a lending asset. Basically going to lend companies money to the fact that they basically probably won't be able to pay the loan back, which is why they're leaving interest rates so low. When interest rates remain this low, they can't force companies to pay interest on top of that when they're not even guaranteed to be making profit for the next couple months. So like he said, they're going to keep interest rates low. They're not going to look at taking them negative until weathered events through the coronavirus have subsided. And again, right here, you see, once they are fully up and running, the Fed's programs will buy both newly issued debt on the primary market and debt that is already being traded on the secondary market. The programs were expanded on April 9th to include some junk bonds. So let's dive into this a little bit more. Primary market is newly created debt. This is brand new. This is where companies are straight up like, hey, we've got $500 billion. We need to get this out. And they give it to the Fed. The Fed gives them money and so forth. Secondary market is debt they already own. So picture it like you've got a mortgage, you've got $100,000 on your mortgage loan, and you're like, hey, I need to get this debt off me. I need a $100,000 loan so I can work with this, pay this off, continue flowing my business as normal. So they give you the loan. That's the secondary market. So primary is like it sounds. Primary is the first one that comes out. Secondary is one that's already owned and continues thereafter. So what is now happening is April 9th to include some junk bonds. These junk bonds are the fallen angels I mentioned, where they're basically buying bonds of companies that you wouldn't expect to pay back loans. Like no bank is going to give loans to these companies, and that's why they've tightened up their lending standards to the extent that the Fed will have to do. So that's why they're doing this. That's why they're having to do this, is because these companies won't survive without it. They have to buy these junk bonds because they know the only reason they're suffering is from the coronavirus. Well, what they don't know is, will they continue suffering after the coronavirus, or will they be able to get back on their feet and have the consumer confidence to go back shopping, to do whatever it is necessary to return things back to where they were? My take, no, things will never actually go back to the way they were, but slowly but surely they will find ways to innovate and adapt to the new standards. But that's what that's going into. And now the biggest factor I think that is going to take the banks, like I was saying, when banks go, that will be the fall. Watch that. It's coming up here shortly. So I want to look at that real fast, but this was what the Fed was doing. It's what the Fed was kind of talking about in today's conference that they were mentioning. But let's look at something that will affect the banks here in a couple months, or in a couple weeks for that matter. All right here. U.S. banks weary of mortgage applicants. U.S. PPI signals deflation, which is a key thing where the dollar value rises because nobody's purchasing anything. So when the dollar value rises, supplies, everything else that you want to buy is basically decreasing in value because the dollar value is increasing, which is opposite of inflation. That's what's bad, because the more debt you can encumber, you can basically just end up not paying anything the longer you wait to pay off the debt, because inflation will basically make that debt worth nothing. But when you have deflation, your debt actually increases in value, which you don't want to have. So deflation is a thing that a lot of people don't want to talk about because it's kind of like the dark matter of the universe. It's something that people don't want to believe exists, but is there. So watch that. Powell calls out Congress, Japan to inject cash, S&P 500 down negative 2.2%, yada, yada, blah, blah, blah. We've talked about that. This is what I wanted to point out right here. In the United States, mortgage applications are rising sharply. As I said, people will want to take out loans, try to capitalize on these low interest rates so they can buy the things they need with little to no interest payback. But mortgage approvals aren't, as banks get very weary about borrower risk. So why would banks be getting weary about stuff like this if, the economy is going to come back, if they keep telling us everything's fine, yada, yada, yada? Well, let's take a look at something here, okay? The banks aren't hurting yet. They don't want to encumber a lot of risk because there's no guarantee that everything's going to go back to the way it was. And with unemployment as high as it is, that's a key indicator that something's off. Something somewhere in the economy isn't where it should be, and nobody's saying what it is because, quite frankly, I don't think anybody really knows. So when you're investing, you need to be mindful of this. As banks start to suffer, when banks begin to suffer, that's when they're going to start liquidating assets in order to cover liquidity, to get more money back in their accounts, to hold strong through the times of where they know stuff is about to go south. With that being said, here's where I see banks potentially suffering and why they're not lending as much money. If things don't get back to the way they were, you have people who are renting that are going to be getting evicted. When people get evicted, they no longer have a job. Renters begin to suffer. So all these landlords or developers that are taking on debt for these new projects then begin to have issues with that, and the banks there follow suit, just like Lehman Brothers did when they went under in the 2008 financial crisis. They couldn't do anything, and that's just because of all the crap that's been going on. If we continue to monitor this, we'll see that trickle down into the housing market. Now, one of the things that's very important is that if housing market goes, the banks will go. That's where a majority of their loans are. But how can the housing market go? This is where things get a little bit skeptical. This is why, as an investor, you have to be cautious about where you're putting your money. When I think about housings go, I see evictions increasing. Once evictions increase, there will probably be a month, maybe 2-month window where people who are in forbearance on their loans and basically not paying their mortgage payment because of the coronavirus will begin to end. Once that ends, if the people are not back at work, not making the normal amount of money they will begin to default on their loan. When default rates increase, banks that hold these basically old to new school CDOs are going to start collapsing thereafter because, as you saw in The Big Short, who doesn't pay their mortgage? Am I right? So you go on to see that happening. When default rates begin to increase, the banks will follow suit with that. So that was why I was telling you to watch the banks, because the banks have only so much time. Their accounts receivable is still inflated, but it's only going to be inflated for so long, because once these forbearances begin to go out, once people can no longer basically not pay their mortgage for a certain amount of days, the default rates will begin to climb. And as they decline, if they hit a certain percentage, I have a theory that they're going to get to around 14% just because there's no way stuff's going to get back to how it was as fast as the timeline that they had. I think it was like 90 days or 60 days of forbearance. There's no way things are going to get back to normal like that. So I think we're going to have a bigger issue than what people are actually seeing. So that's one of the things I wanted to bring up. This is key for what the banks are doing. And as you saw, the divergence in the loans, they're not approving anybody because they are already at tremendous risk from people not being able to turn to work and not paying back their mortgages already. But as gloomy as everything seems, I'm not entirely bearish on the market overall. While I do think everything is overpriced, the biggest factor an investor can have in the market, especially if he's trying to buy and sell within a certain time frame, is timing. Timing is key when it comes to the market. As everyone says, if I could have shorted at the peak, if I could have bought a call at the trough, I could have made more money. So what are some things to help encompass that? What you need to be mindful of is global economics. As we saw, China's PPI, all that stuff began to look gloomy. China's economy fell. Therefore, our markets opened green but fell shortly after and have been falling ever since because more countries are coming out with a worse economic outlook than they are expecting. And because of that, markets have to adapt accordingly. You cannot fudge those numbers. You cannot let that bring the consumer up. You cannot bring the markets up. The only way this is all correlating is global economics. So watch foreign markets, watch the Asia markets, watch the European markets, watch the Australian markets. I've noticed those big three are indicating a lot of what our market does thereafter. So if Asia closes red one day, we close red that same day, or vice versa. It may trickle out into the other depending on whose economic data comes out when. So watch those things. That's the biggest thing. I will show you two stocks that I actually believe have a great opportunity to be bullish here in the short one. But long term, I think they will go down. But of course, if you buy a short too early and you try to just hold it that whole time, the stock could eventually get so high that your put is so far out of the money that you won't be able to make anything, even if it drops back down, because that's how they're, quote, cushioning the blow by basically running everything up so that when it does drop again, it doesn't drop nearly as low as it should. It still remains overvalued. So let's take a look at two stocks that I believe actually are bullish short term. So the first stock I want to take a look at is Netflix. Now, a lot of people are thinking, oh, Disney's going to come out and fight this. Disney just lost $1.4 billion, so I don't see how they're going to be able to combat this right now. And I'll tell you my opinion on why I'm actually bullish on Netflix right now. I'm not bearish on everything in the market. There are things I believe can actually yield a very great return in markets like this, and Netflix is one of them. Now, My reason for Netflix. Netflix actually has a great program where they're beginning to expand and incorporate big name actors that people want to see. Chris Hemsworth movie that just came out on Netflix is actually doing very well. And I think Netflix is going to have the opportunity to capitalize on movie theaters that are either A, just going to have to file for bankruptcy, or B, just aren't going to be doing as well because people aren't going to want to go around during the coronavirus. So what does that have to do with what else people are seeing? I think that even though everyone thinks Netflix is overvalued, which I am 100% with it, the more money the Fed puts in the market, the more this is going to be going up. The Fed is going to be buying stuff that will make them money in the long run. They're going to try to keep some stuff afloat, but they need to make money. So what I've noticed in Netflix is that on very, very, very light volume, this stock is skyrocketing. And it's crazy how much it's going up relative to how much volume is going in there. It makes absolutely no sense, but that's what happens when you get stuff that is astronomically overvalued. Short term, yes, I believe Netflix will continue to capitalize, and potentially even long term, I think Netflix will capitalize, as a lot of producers of the movies begin to see this as an opportunity to show premieres for movies that are coming out, as people can just stream them from their home, pay a royalty, pay a fee to view it, whatever it may be, blah, blah, blah. But that will be a great asset, and I think Netflix knows that, and I think they're going to begin capitalizing on that, and investors have picked up on it, hence why their stock has begun skyrocketing over these past couple weeks. So Netflix is one I'm actually bullish short term on. I don't like to be. They are tremendously overvalued, but short term, that's why I think they are. Investors are realizing the potential that Netflix is going to have to be able to capitalize on a market like this. So that's my take. That's why I think Netflix is bullish short term, but long term, I'm not too sure what they're going to do. I think their stock will readjust, reevaluate, correct itself eventually, but again, you have to time it. And timing right now is saying that this stock is more or less bullish. So that's one I like to watch. Another one that I think is going to be bullish in this short term, Nvidia. Now, as crazy as this is, these are both tech stocks. So tech stocks in general, if you watch the market today and the massive sell-off we had, Nvidia and Netflix both had tremendous resilience when it came to the sell-off. Netflix actually closed positive, and Nvidia was right there behind it. It almost basically closed at zero. It didn't go up, it didn't go down, but that's a great stock to hold when it shows how much volatility is in the market. Short term, I think this is very bullish. They've got a lot of great news coming out. This stock has been rallying like nobody's business for the past month. I think they're up like $60 within a month, which is crazy. If you would have held a 2-3 month, even a month out option would have made you tremendous returns. Even all the indicators are actually, telling us that this is a very good stock to be holding right now. So short term, Nvidia is very bullish. Long term, I don't like to think it is, just because of all the stuff, again, I've heard coming out from Trump talking about trade with China. Trade war comes out, this stock suffers tremendously just because of the tariffs that will be implemented. So once that passes, this will rocket back up again, which, again, that's timing. When you notice the tariffs come out through the news, you have to stay informed, which my channel is designed to keep you informed. I will keep you up to date on the stuff I watch, and I will share my thoughts with you. But again, this isn't saying go buy this stock. This is telling you why I think it's doing what it's doing, why I think this stock has the potential to be a great investment for the time being. But that doesn't mean go buy the stock right now, because nobody knows what the stock's doing. I'm telling you what I see the stock doing and what I believe the stock can do in the future. So to kind of close out this video, I want to talk about the last thing that looks like, is going to be coming out into play, just because of what Jay Powell said as well. And we'll kind of end on that note, because it might be a little bit of positive information for everyone out here. So let's take a look at that here real quick. Alrighty guys, so the last thing I want to talk about here as we wrap up this video is the $3 trillion coronavirus relief bill. Now you may see this and think, okay, well, how does this help me invest? You need to see the big picture that's embedded within these bills. If we scroll down, we'll see hazard pay for frontline workers. That'll be a great enticement for people to actually want to come back to work. But this is the key point that investors need to pay attention to: extension of unemployment benefits. So this is where I like to use the saying, keeping the man down. There's the belief that when you get on unemployment, you're on it for life, just because the government basically feeds you with the silver spoon. And as it says here, the proposal would extend a $600 per week boost in unemployment insurance established under the CARES Act until January 2021. So the government was originally expecting people to return to work within 6 months, but if this bill gets passed, they're not going to be expecting anyone to return to work on unemployment until January of 2021. Imagine that, guys. Imagine all these companies expecting to rehire people, or saying they're going to rehire people through furloughment, and then bam, something like this comes out. Do you not see the picture here? Do you not see that these jobs aren't coming back? This is a way to keep people on unemployment, keep people being fed with that silver spoon, and just let them forget everything that happened. Clearly, that should be an enormous red flag to investors. That's why long-term, I think the markets will somewhat correct. Maybe they won't. Maybe the Fed is just going to keep pumping limitless dollars in there until there's a stability somewhere. This is something that's going to be huge. People remain on unemployment until January of 2021. There's going to be no incentive besides the hazard pay, which that's only for frontline workers, aka the essential workers. People aren't going to want to come back to work. And especially if they can stay on it for that long, it's going to be more beneficial for the companies because they won't have to pay them. The government will pay them, but it's not going to be as beneficial for your taxes because you're probably going to have to pay an arm and a leg to pay for this garbage. Literally, you're probably going to have to sell your arm and your leg in order to pay the taxes that you're going to have to pay within the next coming years because this is astronomical. This is absolutely crazy. Either our dollar value is going to go in the garbage from all of this, or we're all going to be selling livers, kidneys, and whatnot in order to pay for our taxes. So that's huge. Another thing that they're looking to doing is direct payments to Americans. The bill would implement a second round of direct payments to Americans to assist with the fallout of the pandemic. It would provide $1,200 to every family member. Wonder if there's like a dollar value for that as well. Make it over $75K in it. I don't know. Including children, and up to $6,000 per household. Now that's what we need. That is something I mentioned in my previous video where you have to get the money to the people and you have to get them to spend it. This will not help with anything if the people get the money and hoard it. If anything, it's going to show more signs of instability, more signs of insecurity that the market might not come back. Monitor this. This is something they're really trying to push here. I believe it's going to get passed just because, yeah, the economy is that bad and people aren't realizing it. But if this gets passed, this will be a humongous indicator that, yeah, it's as bad as we're thinking. And maybe things will get better, or maybe things in the stock market at least will remain the way they are just because they're doing so much to save their entire economy from collapsing. So this was the last thing I wanted to end on here, guys. Watch this. This is what investors watch. You're no longer a day trader. You're no longer a stock trader. You are an investor. Consider yourself an investor. You know, the Lil Wayne quote, every time the cookie crumble, everybody want a crumb. Don't take the little profits, guys. Buy your calls, buy your puts, trade the derivatives, buy your shares, and hold them. Hold them, and then whenever you see the amount you want, because you are so informed in the market that you know it's going to continue to go up, or yeah, now it's going to drop off because this happened, then sell it. Then do what you want. But don't take the crumb just because you see a short return on a little bit of money. Don't do that. You're informed. You know what you're doing. Invest that way. Become an investor. Don't become a parasite. Don't day trade in the market. Learn from people around you. Take information from those who know more and apply it to your skills to grow your wealth. You know, share it with others around you. Share this information. Let people know that there are people out there who want to help them through this time. You know, I get people all around me that are like, oh, I can't do this because I don't have money coming in. I'm like, there are infinite amount of ways to make money. And one of the best things I see is in the stock market. And people think it's gambling, but those who also think it's gambling don't know about Vegas. You go to Vegas, that's gambling. Here, there's clear indicators that if you just do a little bit of research, you know what's going to happen. You know, in this time of being quarantined, I've probably done anywhere from 400 to 500 hours of market research. I consider myself an expert in this field just because of how in tune I am with everything going on. And the coolest thing about it, guys, when you're this informed, it's almost like you can see what's happening in the future. Like I remember when me and my buddy saw the market coming down and we started actually looking at what was going on, you know, everybody was going about their day like nothing was wrong. And we just looked at each other like, dude, how do people not see what's coming? Like, how is everybody just acting like nothing's wrong when they don't realize the biggest fall in America is about to occur? Like, it was mind-blowing that people weren't reacting to it. But, you know, we saw it. So, of course, we capitalized, we adjusted, we made sure we were prepared. And now you can still be prepared. You just have to be informed. So, watch this, guys. Give this video a thumbs up if you found this investing advice helpful. You know, I want you guys to learn how to do this. I want you to like my channel. I want you to stay informed. I want you to subscribe because I want you to learn how to invest with me. I don't want you to take this as like, hey, go buy this stock, go buy this, be bullish, be bearish. No, I want you to see how an investor actually invests in the stock market. So with that, guys, I appreciate you so much. Thank you so much to everyone who's shown the love and support of the channel and all that. I've learned everything, the comments. I greatly appreciate that. I make sure to go through and try to like every single one that comes up, just because, you know, I'm blessed when you guys actually appreciate what I'm putting out there. You know, not a lot of people can understand what I talk about, but when people show that they appreciate me doing this and that they are actually learning something, it makes it feel all the better. It makes me want to continue putting these videos out there. With that, guys, I hope you have a wonderful week. We will reconvene on the market close Friday to discuss things that have come up therefore and what we thought in the market was going to happen thereafter. So with that, guys, again, this is Life with Caillou. Thank you so much for tuning in on another investing segment. Hope you've learned enough, and I hope you will continue to learn with me through these next coming months, through these years, and that we can grow in our investing together, and we will become investors as a group. So take care, guys. Stay safe and have a wonderful week. We'll talk on Friday.